Friday's market sell-off has added to a complicated economic picture for the Fed's monetary policy trajectory. Joining us now, Roger Ferguson, former Fed vice chairman and a CNBC contributor. Roger, thank you so much for being here on a day where I think a lot of people are tuning in to make some sense of the events over the weekend. How do you think the Fed is assessing the geopolitical risks that we are kind of witnessing in real time, especially as it pertains to their quest to bring down inflation?
Well, I think the first thing they notice is while there's a great deal of turmoil in the Middle East and some loss of life, obviously, from this most recent attack in Israel, the markets themselves seem to be taking it in stride thus far. Oil prices have not spiked, as far as I can tell. European markets seem relatively quiescent. So I believe right now the Fed has the ability to continue to focus primarily domestically, because these geopolitical crises at this stage seem not to be spilling over into financial instability or increasing the pressure from oil markets that could lead to greater inflation right now.
So in terms of their posture of being patient and kind of looking into the year, we were having this conversation earlier with Steve Leisman and Mike Santoli about, what this means for a rate cut perhaps this summer. Do you think this changes that dynamic at all?
At this stage, I don't think it changes that dynamic. The Fed has been saying that they want to be convinced that inflation is on a downward trajectory. The last three CPI reports, both headline and core, I think are not consistent with that conviction increasing. So, the markets have pushed off the notion that there will be a cut this summer. And I don't think this geopolitical concern has changed that. Things that might change it if there is some sign of dramatic absence of liquidity in markets and disorderly markets. That does not seem to be the case right now. Or if there is a change in terms of the outlook and markets collapsing, leading to a decline in so-called wealth effect and putting downward pressure on growth. But right now the economy seems to be solid. So I think they're going to stick with their, waiting to be convinced, and I think that means cuts are further delayed, and some possibility no cuts at all this year, depending on how the data play out.
In the no cuts category, a little bit. I mean, this is where Steve Leisman and I was. But you're on the other side of this, Mike Santoli.
Well, I mean, I don't know if I'm on the other side of it, Roger, but I do wonder if you do think as if what the Fed is doing right now is kind of looking for the minimally acceptable progress on inflation to where they can at least do some of these optional cuts in there. Certainly not necessarily by June, but at some point, if that's the way they're leaning.
Look, I think there's a 10 to 15% chance of no cut. So I'm not in the no cut at all camp yet. It's too early to say that. Having said that, look, I think they really have to be very consistent in their message. If it's hard for them to look back and say, oh, their degree of conviction should have gone up now. So obviously postponing. And let's wait and see. The other thing to understand is, underlying inflation does appear to be a bit stickier. That may be a little bump in the road, but right now I think it's too early to presume it's a bump in the road. And they certainly don't want to make the mistake of starting a cutting regime and only to have to reverse that later. So I think the wisdom is wait and see, no rush to cut. And in fact, if inflation doesn't continue to come down in an orderly fashion or some fashion, no need to feel pressed to cut because the underlying dynamics don't support that move.